Wouldn't you love to be a business owner without ever having to show up at work? Imagine if you could sit back, watch your company grow, and collect the checks as the money rolls in. Now, this situation might seem like a dream now, but really it's closer to reality than you might think. Now, stocks are a part of nearly any investment portfolio that you have. When you start on your road to financial freedom, you need to have a solid understanding of stocks and how they trade on the stock market. Now in this video, I'll be covering the very basics. So if you already have some experience trying the stock market out, this might not be as of interest to you, but it also might instill some clear-cut pieces of information that can build your foundations even further. Now, over the last few decades, the average person's interest in the stock market has grown exponentially. Despite their popularity, a lot of times most people don't fully understand stocks. I see a lot of people, they say you need to graduate at Harvard Business, Penn Wharton. It's the same as gambling. So much of this misinformation is based on a get-rich-quick mentality. People thought that stocks were the magic answer to instant wealth, which just isn't true. Stocks can and do create massive amounts of wealth, but they aren't without risks. The only solution to this is education. The key to protecting yourself in the stock market is to understand where you are putting your money and how and why you're doing it. Now, to provide the foundation you need to make investment decisions yourself, we'll start by explaining what a stock is and the different types of stock, and then we'll talk about how much they're traded, what causes prices to change, how you buy stocks, and much more. Now, what are stocks? Now, stocks is a share in the ownership of a company. Stocks represent a claim on the company's assets and earnings. So when you have more stock, your ownership stake in the company increases. Whether you say shares, equity, or stock, it all means the same thing. Now, being an owner. So holding a company's stocks, meaning that you are one of the many owners or shareholders of a company. And as such, you have a claim to everything the company owns. Now, this means that technically you even own a tiny sliver of every piece of furniture, every trademark, and every contract of the company. As an owner, you are entitled to your share of the company's earnings as well as any other rights attached to the stock. Being a shareholder of a company doesn't mean that you have a say in the day-to-day running of the business. Instead, one vote per share to elect the board of directors at annual meetings is the extent to which you have a say in your company. Being a shareholder doesn't make it so that you can boss Bill Gates around in his company. Now, in reality, individual investors like you and I don't own enough shares to have a material influence in the company. It's really the big billionaire entrepreneurs. Now, shareholders not being able to manage the company isn't too big a deal. After all, the idea is that you don't want to have to work for the company. The importance of being a shareholder is that you're entitled to a portion of the company's profits. Now, profits can be sometimes paid out in the form of dividends. Now, the more shares you own, the larger the portion of the profits you get. Now, another extremely important feature of the stock is its limited liability, which means that as an owner of a stock, you're not personally liable if the company goes bankrupt. Other companies, such as partnerships, are set up so that if the partnership goes bankrupt, the creditors can come after the partners personally and sell their house or car or furniture. Owning stock means that no matter what, the maximum value you can lose is the value of your investment. So debt versus equity. So why does a company issue stock? Why wouldn't the founders just keep all the profits to themselves? The reason is that at some point, every company needs to raise money. There are two ways to do this. Companies can either borrow it or raise it by selling part of their company, which is known as issuing stock. A company can borrow by taking a loan from a bank or by issuing bonds. Now, both methods fall under the term of debt financing. On the other hand, issuing stock is called equity financing. Now, issuing stock is advantageous because it doesn't require the company to pay back the money or pay interest. All that the shareholders get in return for their money is the hope that the shares will someday be worth more. When you buy a debt investment such as a bond, you're guaranteed the return of your money along with interest. This isn't the case with an equity investment. By becoming an owner, you assume the risk of the company not being successful. And as an owner, your claim on assets is less than creditors. This means that if a company goes bankrupt, you as a shareholder don't get any money until the banks and the bondholders have been paid out first. Now, risk. Now, there are no guarantees when it comes to individual stocks. I personally have a lot of experience in that. Now, some companies pay out dividends, many others do not. And there's no obligation to pay out dividends, even for the ones that have in the past. Now, although risk might sound all negative, there's also a bright side. So, taking on greater risk demands a greater return on investment. This is the reason why stocks have historically outperformed other investments such as bonds or savings accounts, etc. Over the long term, an investment in stocks have had an average return of around 10%, extremely good. Now, what are the different types of stocks? There are two main types, common stock and preferred stock. Now, when people talk about common stocks in general, they're most likely referring to regular stocks. In fact, the majority of stocks is issued in this form. Now, we basically just went over common stocks. Common shares represent ownership at a company and a claim on a portion of profits, which are dividends, and investors get one vote per share to elect board members, yada yada yada. Now, over the long term, common stock usually has higher returns than almost any other investment. Common stocks, however, have the most risk. Because if a company goes bankrupt and liquidates, the common shareholders, won't receive money until the other investments are paid. Now, preferred stock. So, preferred stock usually doesn't come with the same voting rights, but may vary depending on the company. So, with preferred shares, investors are usually guaranteed a fixed dividend forever. Another advantage is that in the event of liquidation, preferred shareholders are paid off before the common shareholder. So, preferred stock may also be callable, which meaning that the company has the option to purchase the shares from shareholders at any time at a premium. Now, a good way to think of preferred shares, at least how I see them, is to see them in between bonds and common shares. Now, what are the different classes of stock? So, when companies want the voting power to remain with a certain group, different classes of shares are given different voting rights. When there's more than one class of stock, the classes are traditionally designed as Class A and Class B. So, for example, Berkshire Hathaway, the company of Warren Buffett, has two classes of stock because he wants to keep that ownership. Now, how do these stocks trade? So, most stocks are traded on exchanges, where buyers and sellers meet and decide on a price. Now, some exchanges can be physical locations in which traders are wildly throwing up their arms, waving, yelling, and signaling to each other. The other type of exchange is virtual, where traders are made electronically. Now, some of the most popular include the New York Stock Exchange, NASDAQ, which are physical and virtual, respectively. Now, what causes stock prices to change? So, stock price change every day by supply and demand. If more people want to buy a stock than sell it, then the price moves up. Now, conversely, if more people want to sell a stock than buy it, there will be greater supply than demand, and the price would fall. Now, this comes down to figuring out what news is positive for a company and what news is negative. So, just about any investor you ask has their own ideas and strategies on how to invest. And I'll be making a part 2 about investing strategy later on, so check that out as well when it does come out. Now, the most important factor that affects the value of a company is its earnings. So if a company's results are better than expected, the price jumps. Now, if a company's results disappoint, then the price will fall. Now, the important things are basically, number 1, at the most fundamental level, supply and demand. Number 2, price times the number of shares is the value of a company. And number 3, investors' sentiments, attitudes, and expectations are what ultimately affect stock prices. Now, buying stocks. Now, there's 2 main ways to purchase stock. Number 1 is using a brokerage. Number 2 is DRIPs, or DRIPs. So the most common method to buy stocks is to use a brokerage. So along with the internet came a lot of online brokers, and now nearly anyone can afford a broker. You'll just search them up and find the best one for you, and they'll allow you to enter these stock market exchanges. Now, DRIPs. So dividend reinvestment plans are plans by which companies, for a minimal cost, allow shareholders to purchase stock directly from the company. You can do some other research as well as you like, but for me at least, I just take my dividends and just keep on reinvesting at certain times in the year, certain times in the month, and then I just keep on doing that, and that's DRIP. So bulls, bears, and the farm. So if you haven't heard of these terms already, you undoubtedly will as you begin to invest. So what is a bull? So a bull market is when everything in the economy is great, people are finding jobs, GDP is growing, and stocks are rising. This is when it's really easy to find a company to make money on because literally everything is rising. Now, the bears. So a bear market is when the economy is bad. So recession, 2008, stock prices are falling. So right now, in the time of when I'm recording this video, during COVID-19, this would be a bear market. So bear markets also make it tough for investors to pick profitable stocks. Now, one solution to this is to have a long-term strategy, which is what I do. So none of that get-rich-quick stuff. Long-term is what I've done, and it's almost foolproof if you know what you're doing. I'll tell you that much, at least. Now, the other animals on the farm. So this is a saying where there's chickens and pigs along with the bulls and bears. So chickens are afraid to lose anything. Now, they don't take any risk, so usually they just end up wasting their time, wasting their entire life, 20 years, 30 years, and they don't do anything. They don't get any traction. Now, pigs are like get-rich-quick scheme. They're like extremely greedy, they're extremely impatient, they let themselves get emotional, and they end up giving all their money to, Warren Buffett, which just grabs them up happily and uses it to invest in his company. So you don't want to be a pig. So, as a conclusion, let's just recap what we've learned in this tutorial. So number 1, stock means ownership. So as an owner, you have a claim on the assets and the earnings of a company, as well as voting rights. And number 2, stock is equity. Bonds are debt. So bondholders are guaranteed a return on their investment. The two main types of stock are common and preferred. It is also possible for a company to create different classes of stock. Number 3, the NYSE and the NASDAQ are the most important exchanges in the US. And number 4, stock prices change according to supply and demand. Number 5, to buy stocks, you can either use a brokerage or a drip plan. And number 6, bulls make money, bears make money, and pigs get slaughtered by Warren Buffett and Jeff Bezos. So any of this, if you want to look back, you can rewind the video, get the stuff really ingrained in your head, because this is what will make you a better investor in the long term. And if you're just starting out, this is a great opportunity for you to invest. Warren Buffett said he started at age 12 or something, and said he felt regret because it was too late. But even if you're in your 20s, 30s, teenage years even, it doesn't really matter as long as you're starting now. So I hope this tutorial has given you a good idea of what stocks are and how the stock market works. So make sure you subscribe and like, as I will be making a part 2 on investment strategy. So make sure you hit that notification bell to get notified when that video does come out. So for now, that's it for the video. Thanks. See you later.